Both a SC 606, United States GAAP, and IFRS 15, International, are built on the same core principle. An entity should recognize revenue when it transfers control of a promised good or service to a customer. Control means the customer can direct the use of and obtain the benefits from the asset. Think of a bakery delivering a custom cake. Revenue is recognized when the cake is handed over and the customer can eat it, not when the order is placed. The main difference lies in terminology. GAAP talks about transfer of goods or services while IFRS uses transfer of control. But the practical test is identical, making the standards largely convergent. Practical example, a SaaS provider delivers cloud software. Under both standards, revenue is recognized when the customer obtains the right to use the software, usually at the point of activation. The only nuance is that IFRS 15 explicitly requires an assessment of whether the customer can direct the use of the software, whereas a SC 606 frames it as the transfer of the promised service. In practice, the timing is the same. The 5-step model is the scaffold for both standards. Step 1, identify the contracts with the customer. Step 2, identify each distinct performance obligation, PO. Step 3, determine the transaction price. Step 4, allocate the price to each PO using relative stand-alone selling prices. Step 5, recognize revenue as each PO is satisfied. The model works the same under ASC 606 and IFRS 15, but GAAP gives more detailed guidance on contract combination and enforceability, while IFRS 15 emphasizes the concept of distinct and allows more judgment in separating bundled goods. Illustrative comparison: a smartphone plus service plan. IFRS 15 may treat the plan as a single PO if it cannot be used without the phone. Lack of distinctness. A SC 606 could split them into 2 POs if the plan is usable with any device, applying the distinctness test differently. The 5-step path remains identical, the judgment points differ. The transaction price is the amount the entity expects to receive after adjusting for variable consideration, rebates, discounts, performance bonuses, and a significant financing component, long-term payment terms. GAAP uses an expected value or most likely amount approach, picking the higher of the two. IFRS 15 requires the expected value method unless the range of outcomes is large, then the most likely amount may be used. Variable consideration is constrained. Revenue is only recognized to the extent that it is probable that a significant reversal will not occur. Mathematical illustration. A construction contract offers a 10% bonus for early completion. If the base price is $1 million and the probability of early finish is 70%, the expected bonus equals 0.7 times $100,000 equals $70,000. Both standards would add $70,000 to the transaction price, but ASC 606 may require a stricter test that the chance of reversal is less than 10% before recognizing the full amount. For a financing component, suppose payment is due in 3 years. GAAP discounts using a market rate of 5%, while IFRS 15 may use the entity's incremental borrowing rate of 5.2% if a market rate is not observable. After the transaction price is measured, it must be allocated to each PO based on standalone selling prices, abbreviated SSP. The SSP is the price at which an entity would sell the good or service separately. If SSP is not directly observable, both standards permit estimation using adjusted market prices, cost plus margin, or residual approach. The key difference is in discount rate treatment. GAAP requires the allocation to be performed on the gross transaction price before any discount for financing, then the discount is accounted for separately in interest expense. IFRS 15 allocates the discounted transaction price directly to the POS, effectively incorporating the financing component into the allocation, which can affect the timing of revenue recognized on each PO. Numerical example: gross price $1,200, financing discount $120, 10%. GAAP allocates $1,200 across POS, then records $120 finance expense over time. IFRS 15 first discounts to $1,080, then allocates that amount, so each PO receives a slightly lower revenue amount from the start. Long-term contracts can be accounted for using either the percentage of completion, POC, method or the completed contract method, CCM. Under both the SC 606 and IFRS 15, if a contract meets the criteria for POC, outcome can be reliably measured and the entity expects profit. Revenue is recognized over time based on progress toward completion, usually using the cost to complete method. Revenue equals open parenthesis cost incurred to date divided by total expected cost close parenthesis multiplied by transaction price. If those criteria are not met, revenue is recognized at a point in time, often akin to CCM. Historically, United States GAAP allowed CCM for many contracts, but a SC 606 aligns with IFRS 15 by favoring POC when possible. Example calculation. Bridge builder expects total cost $10 million, has incurred $4 million to date. Transaction price $12 million. Revenue recognized to date equals open parenthesis 4 divided by 10 close parenthesis, multiplied by 12 equals $4.8 million under both standards. Disclosure requirements are where exam questions love to test students. A SC 606 requires a 5-part disclosure: 1 disaggregation of revenue, 2 contract balances, 3 performance obligations, 4 transaction price, and 5 a qualitative discussion of judgments. IFRS 15 adds a requirement to disclose the practical expedients used, and a separate note on any significant financing component recognized. Both standards demand a reconciliation of opening to closing contract assets and liabilities, but IFRS explicitly asks for the impact of changes in accounting policies on revenue. Practical disclosure snippet for a SaaS company. Disaggregation: 5 million annual subscriptions, 2 million quarterly, 1 million monthly. Contract liabilities: 1.2 million deferred revenue at year-end. IFRS note: use the practical expedient to treat certain bundled upgrades as a single performance obligation. Contract modifications occur when the parties agree to change the scope or price of an existing contract. Under a SC 606, a modification is treated as a separate contract if it adds distinct goods or services, and the price increase reflects their stand-alone price. Otherwise, the original contract price and remaining obligations are remeasured. IFRS 15 follows a similar logic but is slightly more flexible. If the modification creates new distinct POS, the original contract is adjusted and the new POS are added. Breakage clauses, for example, no return guarantees, are treated as variable consideration. GAAP requires a high probability test for breakage revenue to be recognized immediately. IFRS allows breakage revenue if the entity expects that a significant portion will not be returned, applying the same constraint principle. Example, a retailer offers a 30-day return guarantee. If historically 95% of sales are not returned, both standards may recognize 5% of sales as a breakage liability. But a SC 606 would only recognize the 5% as revenue when the probability of return falls below 10%. When a company adopts a SC 606 or IFRS 15, 3 transition routes are possible. Number 1, full retrospective. Restate all prior periods as if the new standard had always been applied. Number 2, modified retrospective. Apply the new standard to the opening balance of retained earnings with a cumulative catch-up adjustment. Number 3, cumulative catch-up. Recognize the effect of the new standard in the period of adoption only, adjusting opening retained earnings. The full retrospective method is the most rigorous and is required for public entities unless impracticable. Modified retrospective is allowed for private entities under GAAP and for early adopters of IFRS 15. The cumulative catch-up is used when retrospective application would be too costly, and the adjustment is recorded as a single line item in equity. Illustrative transition. A retailer switching to a SC 606 recalculates its sales return liability for the earliest comparative year under the full retrospective approach, resulting in a $2 million increase in opening retained earnings. Explanation example. A company sells a $1,200 software license with a 10% volume rebate, a 5% expected return, and a 2-year maintenance service separate purchase order. Step 1. Identify contract. One contract with 2 purchase orders, license and maintenance. Step 2. Determine transaction price. Base price $1,200 less expected return. $1,200 times 5% equals $60, resulting in $1,140. Expected rebate. Assume 80% chance of hitting rebate threshold. Rebate amount equals $1,200 times 10% equals $120. Expected rebate equals 0.8 times $120 equals $96. Transaction price equals $1,140 minus $96 equals $1,044. Step 3. Allocate price. Stand-alone price of license $1,000, maintenance $300, total $1,300. Allocation ratio license equals 1,000 divided by 1,300 equals 0.7692. Maintenance equals 300 divided by 1,300 equals 0.2308. Allocate license equals $1,044 times 0.7692 equals $802.31. Maintenance equals $1,044 times 0.2308 equals $241.69. Step 4. Recognize revenue. License point in time, recognize $802.31 when control passes. Maintenance over time, recognize $241.69 over 24 months, equals $10.07 per month. IFRS 15 nuance. IFRS would allow using the most likely amount for the rebate if the range of outcomes is narrow. The numbers would be identical in this case. Both standards would initially record a liability for the expected return $60 and reduce it as actual returns occur.